Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Friday, July 21st, 2023. It is 3:27 p.m. Eastern Time. I'm starting this video, and this is a redo of the other one that did not record. Mentioned that a few weeks back. I had an issue where the audio wasn't recorded. This issue drives me crazy. The software, pops up a little recording window with the tools that's easy to miss, and it only shows you for a few seconds there in the beginning if the audio is not being recorded. I can record 100 or more videos, it works fine, and then randomly every so often it just toggles off the microphone settings, and again it's very easy to miss, and if it happened more often I would make a point to check every video. So anyways, sorry about that, guys. That one I was hoping to get out to you before the close. Nothing major, but I wanted to share my thoughts on where we're going and some key levels to watch for really in next week. That one I had started it early enough to get it out to you before the close, and unfortunately this one will not make it. The only benefit here is this one should be a little shorter since it's my second draft. All right, let's dive into the charts. Here's that 60-minute chart of QQQ. Remember, unless this trend line breaks, which appears imminent and likely to me at this point in time, we don't have a sell signal. So we're really back on it. Last time, well, I've been highlighting it every day for weeks or months now, but we hit it back here. Last time we hit it was there, bounced with a divergent low. So it's kind of a swing, swinging mode. We've been walking our way higher, divergent high, divergent low, divergent high, divergent low, divergent high. You can see your divergence lines down below. And remember that this divergence, even though you might say, okay, well, let's just continue that trend. Well, again, this trade was put on the other day as a short trade for initially a quick pullback trade, but also added and showed you some levels there where it very, very much, and I would say over, the odds favor it, meaning well over 50%, that it has a potential to morph into a longer term swing trade, meaning before we put in a divergent low and have another new high, this thing looks ready to pop. And again, this is the same divergence that's been building. Each of these smaller divergent highs are really just, at least this one and this one, are a culmination of these bigger divergences, and that would indicate a much larger drop if and when it breaks. And this is a near-term swing target, again, 14,432. I gave you a comparable level on QQQ yesterday, so you can check out that chart. So yesterday, let's zoom in. I talked about any bounce back to this level right here, which we broke down. That was a support level. We took it out yesterday, and I said any bounce back to this level would offer an objective short entry or add-on, and that's what it was. So I got that today, and so that's where, could have or should have shorted if you were looking to add to any shorts or get short. And nothing big, again, really nothing big, because today's sort of digesting. NASDAQ is digesting the drop from yesterday, and it's mostly a sideways. We're only down 0.3% right now in the futures here, but we're very close to that trend line. And again, based on my analysis, I think it's going to go. When you look at the 15-minute chart, a little something for everybody. We all see what we want to see. I want to point this out in case you are bullish looking to go long. We are at support. It's that same gap support we hit on QQQ yesterday right here, and it's also this minor support on NQ. And as I show you here, we have a 15-minute divergence. In that last video, I was showing you that we were there. And I said, look, if you are bullish, think the market's going higher, you go long here at support. But I told you, and that, again, you can see it drawn out, but you can't hear me in the last video, that I suspect that level will break, because I am looking for a more a deeper drop after as we head into peak earnings week next week and the following week, with all the rest of the big tech stocks, concluding with Apple on August 3rd, the Fed on Wednesday. Keep in mind, it's going to be a volatile week. So I think there's more downside, and I'll be more interested, as I usually am, in closing out a swing short position when we get divergence on the 60-minute time frame. That's what I like to look for to swing major highs and lows, are positive divergences on the indexes. All the better if you get it on both QQQ, SPY, as well as NQ, the NASDAQ futures, and ES, the S&P 500 futures. That's where you usually get the major turns. And remember, we had, we'll go back here and I'll show it on the QQQ chart. So you go to QQQ, 60-minute chart, we had this was the last divergent low on the 60-minute chart right here, and it gave us this big rally. It was an outsized rally, but that was it. And so we started to diverge right here. I pointed out we had a divergent high what was that, late June, and it did play out for a correction, relatively minor one, but this divergence has only extended. This is the same divergence, only longer, and that's what tends to happen. You tend to get a series. We've had a culmination of 3 smaller divergent highs, 1, 2, now 3, each having their own little correction along the way, and then usually it's that third or sometimes fourth one, sometimes second, that does the trick to finally get you a bigger trend change, and that should take us down to what did I give you? 390. I think that was it. Yeah, 348 was the comparable. And look, that's a minimum target, but a very likely one. It comes in line with a measurement of the wedge. And if and when we start to head down there, I will certainly give you my thoughts as to whether I think that will be the end of the run if we're going to get there. Again, I'm getting a little ahead of myself. We haven't even broken the uptrend line yet, but and then is that time to position long for bounce? Now, regardless of what my views are, and I've always said this isn't a follow me site. I am always glad to give you one of the things you pay me for is to provide technical analysis and trade ideas. I throw in my opinion as to which way things are going to go. I even tell you how I'm positioned, and I do my best to convey my convictions on a trade, whether or not, trade idea, whether I'm taking it, not taking it, if I'm in it or not in it, how strong I feel on it. At the end of the day, that's analysis that I'm providing. You may have a completely different view. So where I'm going, one thing that I think I'm pretty good at is identifying key support and resistance levels. So therefore, someone on the opposite side, opposite view of the markets looking to buy dips, well, here's your levels. And if we happen to get down to that 348 target, it's pretty good support. Nothing huge, decent. That's even better support right there. So I'm showing you the levels. If you believe this market's going to new highs, levels that you can use for a dip buying. And right now, at least the nearby support levels are levels I'm more interested in waiting for a break of support to add to short positions. So hopefully that's clear. In that video, again, the voiceless video I just put out, I gave you my thoughts that I think we would dump today in the end of the close, even though we hit that support level. Remember, the QQQ has been, this is one of the best active trading time frames. I talk on active trading. I wear multiple hats: day trader, active swing trader, typical swing trader. That the 348 or whatever target I just told you, that's a typical swing trade on the for typical swing traders, people that hold for days. Usually a typical swing trade is typically about a week to maybe 3 weeks, 4 weeks, a couple months. There's no hard number there, but it's measured in days to weeks usually. Active swing trading is measured in usually just days, sometimes hours, but usually just a few days or more. And then, of course, day trading by definition means in and out of a trade and within the same day. And again, this is your 5-minute chart. So what I had said, I covered in that video, is even if you're in an uptrend, because I've gotten questions, how can you possibly short this market? I was an active trader. These are all, it's very simple. I've covered this many times. This 5-minute chart is probably the one of the best go-to for active trading, active traders. And again, I line this chart with what I see on the 60-minute daily. What does that mean? Well, for example, let's just say I'm looking to go long on a divergent low. You can see these are all your divergence lines down low. They're all marked: divergent high, correction, divergent low, rally, divergent high, correction, divergent low, rally, divergent high, correction, divergent low, rally. And then we've had this culmination of this, divergences have been building. Even that first divergent low resulted in a little correction, but it's the same divergence and now a bigger correction. And then the other day we hit this this gap right here I mentioned yesterday. That's what capped the drop. We've been dancing on it, and as I said, if and when that gap is backfilled, if and when that gap is solidly entered. Now we only have we have exactly 23 minutes to close. Is it going to happen today? I don't know. I'll probably, maybe. We're already down, expected some weakness at the end of the day. I pointed out that 15-minute, the fact that the NQs were at support and so is QQQ, and with positive divergence. So normally this would be the time to look to go long. Positive divergence on the 5 and 15-minute charts at support to boot, both on NQ and QQQ. Normally, this is where the buyers have been stepping in. Now, if they don't, you're starting to see a change of character. I'm guessing they're not. If they do, look, there's where we've been bouncing. Here's a little, let me box tool it in. There's a little recent trading range. Again, the market's almost closed today, so I wouldn't, with 20 minutes to go, probably just sit back and hold off and wait, pick it up next week, no matter what happens. But my guess is they're going to, on Monday, if not today in the last 20 minutes or so, dump down and start to backfill that gap and or do it on Monday. Again, this is where, and I use those little, my fingers are doing a little quotation thing, quote unquote, the buyer should be stepping in because this is our latest divergent high. But again, that 60-minute divergence and even daily divergence and breakdowns, which I'm going to get to in a second on some of the stocks, we're starting to see finally break down, override and tell you, hey, you might want to quit trading these 5-minute divergent lows now and focus more on the daily and 60-minute charts, because that they are more significant. You get breakdowns on daily and 60-minute charts, it's going to override very short-term bullish setups like this. Okay, hopefully that makes sense. Let's look at a few things and wrap this up. What I wanted to do in this video, and I did in the last one, show you a couple sentiment indicators. Earlier this week, I think it was, I showed you my CPE put to call ratio, equity only put to call ratio, firing at one of my buy points. Again, I have to caution, sentiment indicators are not exact timing indicators. They show conditions, certain conditions. Sentiment indicators, in my opinion, are 1000% useless unless they're at extremes. Never try to extrapolate any useful information when they're in the middle. I've set these lines years ago, been trading off them. You have a little level here that sometimes does the trick, but here's my red zone. My red zone shows extreme readings of the spreads between bullish and bearish market participants. So this is the AAII survey, American Association of Individual Investors. They do a weekly survey, and when you get a big dichotomy, a spread between those bullish and those bearish, you get this up to this level right here, the red zone. That's pretty big extreme there. But this little red line right here, you can see I have a red line here, that often does the trick. So I'm using a blue tool to do it. So on that chart, it's a red line. So let's go back. The last bear market, the last real bear market, in my opinion. So far, this is only the first leg down in a bigger bear market with more downside to come. I consider that just a correction because it took us back to some long-term trend lines. Call it what you want. Semantics, really, whether you want to call it a bear market or correction. The old antiquated 20% rule doesn't mean anything to me for bull and bear markets, not in recent years. Those are just corrections. So you can see a perfect tag right there. Boom, in October of 2007, that was coincided perfectly with a market top. It may not look like much here because this is not log scaling, and this is the S&P 500 down below, but that was a 55% drop from October of 07 to the March 09 lows in both the NASDAQ and S&P. So that told you get out. Everybody was too bullish. We hit it again on the first and big bear market rally. We had if you remember trading, or you can see it on the charts, you can go back. In the spring of 2008, we had a pretty healthy bear market rally, charged up the bulls, hit regular fib retracements just like this one. This is just, again, everything's on a bigger magnitude. Ever since, again, I'm not using log scaling here, so it distorts these moves. Don't get me wrong, again, that was a 55% drop. It doesn't look like much. It makes it look like this drop was bigger, and it wasn't. That's the downside to not using log scaling. So I just want to throw that out there. This was only a 36% drop. Again, 55. But that was a big drop, and bulls got just as charged up, and look, bing, to the button, hit that level, and then we had the biggest drop. So I just wanted to point that out. That's there. The downside to this is sometimes you hit these levels, nothing's guaranteed. Sometimes you hit extreme bullish sentiment and you get even more bullish, or you stay bullish for a while, but quite often it's one and done. All I wanted to do is point that out, that now that's the second sentiment indicator that I've had hit one of my buy zones again. And usually these are marking tops when you hit these big extremes. Remember, this was a big, we hit this big extreme back here. That was that big fourth quarter drop in 2018, one of the biggest drops. And so in a bear market rally, you're usually not going to get back to the extremes that you got to right before the bull market ended and the bear market started. So just keep that in mind. That's from, again, my experience looking at these charts. If you missed it, here's the other sentiment indicator that fired earlier this week or last week. That's the CPCE. That is the put to call, equity only put to call ratio, measures the ratio of put buying versus call buying. So if everybody's buying calls, more metaphorically, more so, you hit the extremes. Again, only good at extremes. Then that is a contrary indicator that everybody's bullish. And the way these things work, sentiment indicators, when you hit these extremes, and again, I'm speaking metaphorically or generically, not literally here. If everybody's bullish, no one else is left to buy. And if everybody's bearish, everyone's thrown in the towel and capitulate. There's no one left to sell. Okay, again, not literally, but just generically or metaphorically speaking, that's why we look at these extremes, these ranges. They're not bounded. It's a ratio. So there's really no bound to the upside, and the downside is technically bounded by zero, but it's, it's going to approach there on a log scale. So it's not, but you can see here, quite often it's one and done. Since the bull market started back in 09, the last bull market, boom, you hit it there. You had the biggest drop by far up until, at that point in the bull market. Next time you hit it, you had an even bigger drop. Didn't hit it again until 2014, one of the bigger corrections there, but more so it set off this almost 2 years of sideways market here, because we hit that bullish extreme and the market went nowhere for 2 years with a few big corrections in there, then resumed. And you didn't hit it again. As I talk about, quite often it's one and done. And then other times you have what I call clusters. Those are multiple readings of the extreme levels in close proximity. That's exactly what you had when the market bottomed here. It started bottoming in October of 2022. In firing on this, everybody was getting too bearish. And then that gave us the rally that we're at today. Okay, so, but we've come full circle. We've hit that reading again, as I pointed out earlier in the week. So these are a couple things that's showing us that, hey, guess what? A lot of folks are jumping on board the bull wagon. In this one, again, the AAII is what I call a sentiment indicator in rhetoric, because that's a survey. It's people saying what they're going to do if they're bullish or bearish, but they don't have to buy or sell. When put to call ratios are measuring actual bets on the market, people where they're taking their money out of their wallet, metaphorically speaking, and placing bets that a stock is going to go up or down. Yes, there's a hedging element, but that doesn't matter. It's all factored into here. Again, you got a lot of people buying calls, and more so than puts. That's where you hit. And when everyone's buying puts because they think the market's going to drop and they're not buying calls, that's where you go. So that's that. Okay, and what I wanted to do in this video and did in the last one is just going to show you that where I think the opportunities lie right now. To be very clear, just up front, I favor, as far as indexes go, I think the most bang for your buck, if you are bearish and looking for a pullback, tradable trend or correction, swing trade, whatever you want to call it, the NASDAQ 100. And the point of this video, because I've been saying that lately, within there, I'm going to tell you one of my favorite sectors is the semiconductors. I covered that in detail yesterday, so we won't go in a lot of detail. I'll just give you a quick recap here for those catching up. This is SOXX, one of three main big semiconductor ETFs. They're all singing the same song to me right now. They all have these clean divergent highs, clean bearish rising wedge patterns. I told you yesterday we have support just below on most of them, 507 on SOXX. This one's pretty top heavy in NVIDIA. With NVIDIA breaking down today, this one I think will outperform on the downside, just like it outperformed on the upside on the way up, due to NVIDIA, which has the highest weighting. That's the biggest semi. My target remains 482.50 first target, and then the trend line right here. So you have a small wedge right here, just like you had a smaller wedge here. and right there, a small wedge. That wedge breakdown took us to the uptrend line. This one I think will take us to the uptrend line again at minimum. Zigzag our way down there. You're talking a drop of about 9-10% if so, and it's these negative divergences that tell me that's the most likely case. The other ones out there are XSD, same thing, negative divergence, clean uptrend line, and nice support that needs to give way. We're right on the trend line as well. So these guys haven't yet fired a hard sell signal, but it looks imminent, looks right. These are wedges look ready to break down at any moment. But like I like to say, I thought Meta was a few weeks back, and Apple. I gave you those setups. Apple did break the trend. Meta just now broke it. I'm going to get to those in a second. To be very clear, it's not an all-in or an aggressive short moment, because support is support until unless broken. And so, boom, there it is. However, with that being said, I like the posture so much, and I'm seeing some techs already, semis already break down, that I do believe it warrants having again, depending on who you are, for me personally, having a position in which to add to, going into the weekend with some short exposure to the semis. And then if and when we get the additional confirming sell signals breakdowns, that's going to take us down to the next target there, 207.42, and quite likely down here 192.15. That's XSD. And then you also have SMH is the other one. And same thing. So you can see it's, even though these have a different basket and different weightings of the semis that they hold, they're all, setting up in these wedge patterns and look ready to go. And most of these are just extensions of these divergences that have been building for a while now, really. So it's, you had one little wedge here, broke down, had that one more thrust higher. And this, gave a lot of people the feeling of invincibility in the semiconductor sector. And it's just, anyways, and we're also, I'm gonna move or give you one more line right here. There's a previous high right there, and that's pretty much where we're challenging on SMH. All right, now let's go into the NASDAQ. So here's what I want to show you. So in a nutshell, SOXX or any of those semiconductor ETFs, and more particularly the individual semis that I showed you the other day, the ones with the most bearish charts. So I'll give you a couple, individual semis, and some that are above trend, some that aren't, haven't triggered a breakdown yet, and showed you some of the better looking ones if you want to trade those individually. What I want to do in this video, and then we'll wrap this up, is show you the same thing within the NASDAQ, how clearly to me, tech, particularly big tech, has the best looking RR, risk reward ratio, the most attractive short setups. In fact, there are quite a few companies in the NASDAQ 100 that I cannot make a case to be short at all. And so if you want to outperform, I'm going to give you, I'm not going to go through them all. We'll go through the top dozen or so holdings in the NASDAQ 100. And I'll show you that some of the charts look either neutral or even bullish to me. And those are typically the non-tech companies. Just about all things tech look like they're due for a correction. So the takeaway is you can use XLK. This is QQQ. XLK is the tech sector ETF. And if you, here, let me just change this to XLK. And you can see it's almost a perfect mirror of the NASDAQ 100, because the NASDAQ 100 itself is over 50% tech. So you can see it's almost a perfect weighting, but I think you'll get a little bit, alpha, outperformance, if you will, being short tech. Or for those of you inclined, so I'm doing this video for two reasons: to show you, overall analysis, to make a case that the NASDAQ is probably going to go down from here, and the other thing is, if you are so inclined, I think you can outperform the NASDAQ by shorting the most bearish stocks individually, if you are so inclined, if you have the skill sets, the inclination, build a portfolio of 12 2 dozen individual stocks, and that's what I'm going to do. I'm not going to go all through all 100 components, but kind of just give you that overview I'm talking about, and show you why it's that some of the other stocks in there really don't look as bad. Let me turn that off.
Order filled. Order filled.
Damn it. Okay, let's see. I deposit. Pick it up here. So Alphabet, they're going to report Tuesday as well after the market close. We had that divergent high right there, negative divergence. Kind of flounder around between this support and resistance zone. My opinion on this one isn't as strong, although I will say that was big resistance. So far, we've had a failed breakout, but I'm not going to say it's failed by a large margin. It's not by a large margin. It's right on that level now. And this one, playing that guessing game, you know my thoughts. I think Apple goes down. I called the same on Netflix and Tesla so far. They played out. This one, as of today, and again, a lot's going to happen between now and 4 o'clock on Tuesday. As of today, I could easily see a after hours or even a early Wednesday pop to give us one more marginal high that gets sold into, final buying climax there post earnings, because any new high from this point next week will be 100% guaranteed a divergent high. The only way it wouldn't be, you'd have to shoot up here and burn right through these divergences. So that would be a pop that I would probably most likely be shorting into on Alphabet with stops somewhat above. But again, let's see how it happens. And I'm just giving you my play-by-play call on each of these as we head into earnings season. Now, where's it going to go? Ultimately, I think a lot of these stocks, I'm looking for pullbacks at minimum, swing trades or more of a longer-term trend trade to these uptrend lines off the lows. And then ultimately, I think those will break, but we're getting way ahead of ourselves. But if you just want an idea, hey, how far might we pull back, even if this market's going higher? I think those are good targets. It wouldn't happen next week. Take a little while to zigzag our way down there, because that'd be a pretty hefty drop from where we're at now, depending on if and when we got there. Come in about the $100 level, be about a 16% drop. Before then, we have excellent support right here, very good target, and a likely target in my opinion in the next few weeks. I think this target will be hit within a month, about 108, and that's about a 10% drop. So again, whether we my crapshoot whether we do that or that. And that's where I think Alphabet's going. Amazon broke down already. A lot of these I've covered quite a bit recently. We had a breakdown right here. We had a little minor uptrend line. Let me click on my trend line tool. We had a breakdown, back test, another another marginal new high. The divergences have been extending. They're starting to get pretty steep right now, indicating the trend reversals are likely coming very soon and imminent, which is one of the same things. Lots of reactions on this BOD, or what I call benefit of the doubt support line. I already have an alert set. I'm pretty sure I'm going to set it again. So that is a stock to me. That clearly looks to be headed lower, despite the fact that it's at a 52 week, or at least 2023 high right off it. We're at resistance. Should it pop after earnings, your next big resistance is right up here at 146. Pretty big resistance as well. And again, you want to see this trend line break. There's your sell signal right there if and when that goes. And again, another tech stock that, again, minor pop up or not, looks to be headed lower in the coming weeks to months to me. NVIDIA, king of the semis now, broke down today. There's support right here, it's 439, about 440, but that is a breakdown. There's that wedge I gave you yesterday, so that's sell signal and negative divergence. And the nice one about this is an active short now. They don't report till August 23rd, so there's plenty of time before you have to worry about earnings in this one. Now, the other big semis, as they report, have the potential to, carry over to NVIDIA. That's how it works. So we'll see if as in the next week or two, as more and more semis report, we'll either build on this breakdown, which I believe we will. There's first target 403.30, second target 375, and then a massive gap to be backfilled once it's entered all the way down to 317.72. So that gives you the potential on NVIDIA of my minimum preferred swing target. Hopefully that makes sense. 17%. By that I mean this is support 440. That's not a target. It's too close to the breakdown. This is my first target 403.30, about 11% drop, 10% drop. And then this is my preferred swing target 375, 17% drop. So I see something like this. Either we kick back, maybe back test, or we break down next week, hit that first target, have a reaction, hit the second target. And then depending on how things are going at that point in time as we come down there, I'll decide whether or not to extend down towards, really the gap is right here at a 302. So, we have a reaction high just above it. Anyway, just want to point out that's broken down. And again, another tech stock and a semi, which is a subsector of the techs. So kind of goes in line with what I was saying. XLK, QQQ, as far as my favorite sector to short, XLK, if you wanted to just strip out some of what I'm about to get to, the better looking stocks in the NASDAQ 100 that are going to help to I think XLK, the tech sector as a whole, is going to outperform to the downside, fall more than QQQ, if I'm correct, in the coming weeks to months. And then and the semis should fall even more than the tech sector itself. So that's how I'd rank that. Now that cuts both ways. SOXX and the semis are much more volatile. They move more in a day-to-day basis. So if you're wrong on that trade, you're going to lose more on semis, most likely. No guarantees. Sometimes the semis may go down and tech's holding up, but that's how that works. So keep that in mind with your position sizing. You don't want to short as much SOXX as you want to short, say, QQQ, because QQQ is diversified more. You don't have as much volatility or risk, if you will. Okay, Tesla, well, we already called that one, ran right up to the primary bear market downtrend line, rejected, follow through downside today, stalled, traded all day yesterday and most of today on that bottom. Remember that gap I told you we hit yesterday and traded there, but a very muted bounce. The buyers just have left the building on this one, and we closed down below that 260, 280 support. So that's going to open the door to this next target down here now, 237.80. Tesla, and of course another tech, considered a tech. Obviously it's an automaker, but a lot of people lump that in the big tech category. Meta I put out as a trade idea way back here, and I was very clear it was not an actionable trade, no sell signals yet. It's been testing the trend line, and finally yesterday we had our sell signal. It broke down, the solid red candle, solid red close, follow through today, even took out the minor trend line. Reports Wednesday after the market closes next week, but that's on a sell signal, and my targets have not changed. It's still a lot of meat left on the bone. T1 should be about a 21% gain if and when hit. T2 about a 29% gain, and then T3 now comes in with this the downtrend line in the 197-ish level. That's about a 36%, and that's still my final target at this point in time. I may extend it to these potential fourth and fifth targets depending if and when we get there, but that's what I'm looking for on Meta. And again, tech. Broadcom tech. I'm just clicking, guys. I'm just clicking through the components of the NASDAQ 100 in order of market cap. I'm almost done here, about 6 more stocks, just so I can get into some of the non-techs and show you the disparity in the technicals. But everything I'm seeing, again, these are almost all these charts are very similar with these clear negative divergences. Many have blow-off tops. What looks like a blow-off top, a buying climax. You can see back on Broadcom right here. Maybe you can't see it. I have huge volume spike on that buying. We've tried to get to that level, couldn't take it out, and I think we'll break down and ultimately come on in and backfill that big thin zone down there. A lot of downside on Broadcom. ASML, another semi. And this one already recently put in a divergent high, broke down here. Started moving lower, made a back test of the uptrend line, and it's walking its way lower. Again, no guarantees, but these divergences often play out. More often than not, they do. This is big. The last time we had negative divergence like this was back here when the stock topped. You remember back then, maybe you weren't with the site. This is what I called way back here. Trend line. Pointed out this trend line back test. You'll find very few calls like this out on the street, calling for a move down to my second target there. We hit it to the button. My second target wasn't some random level. It was this long-term primary bull market uptrend line. So there's a call, calling that thing down 60% right to the second target where we bounced. And ultimately, I think we're going to hit that trend line again and ultimately go on to take it out. And I'll probably add in a longer-term target all the way down here. And I know most think that's crazy, just like probably most thought it was crazy back here, calling for at the time a 60% drop in the stock when the semis and ASML was coming on all-time highs. Bullishness was every bit, if not more bullish back then as it was right now. This is just, these are the cycles of the market. Everybody gets bullish and thinks things are going to go up forever, but then the technicals tell you, no, that's not going to happen. You're going to get a correction, and big divergences on the weekly chart lead to big drops. Big positive divergences right here on the weekly chart and a hit of support and a primary long-term swing target, trend target is when you want to go long. And so that's, rally certainly long in the tooth, but based on the divergences that we have in place on the daily and the weekly chart, tells me that now it's time for the next leg down. Okay, a few more because I'm hitting all tech so far. Here we go. Pepsi. Here's a stock I can't knock. Now, it doesn't mean I'd go long, but I certainly wouldn't short it. So my point was earlier, you can short everything I covered up to now. I can make a pretty good case to be short those. I can't make a good case to be short Pepsi. I think it'll fall less. It is more of a defensive issue stock. I mean, this is Pepsi. In a recession, people still drink their Pepsi. They're not going to stop buying that if that's their drink of choice. They're going to cut their NFL package out of the dish, but they're not going to stop drinking Pepsi and and beer and things like that are defensive issues. But Pepsi is a very tradable vehicle. You have these uptrend lines and downtrend lines, very well defined. You can see them all. A lot of these were pointed out. You had a divergent high there, trend line break, went down. You hit the primary trend line. So where I'm going with this one is it keeps coming in and checking this trend line every so often. Check, check, check. We didn't hit it on this last break. I believe I highlighted that breakdown there. We're probably going to come down to it. So again, it's not a stock I'd be buying. I have, due to the weighting the tech sector has on the NASDAQ 100, it will most likely give a headwind, if I'm correct, on just about every other stock in there. So again, but if you put a gun to my head and said, Randy, you got to pick 5 stocks to go long here and then 5 to go short, I'd be short techs and semis, and I'd be long stocks like this that are above trend with no negative divergence at all. We didn't have divergence at the last high, and we don't have divergence now. Costco, same story. We don't have, we almost have divergence. This one, I wouldn't be chasing Costco, and it's coming up to resistance, but it looks a lot better than big tech. It's still above its trend line here, and it's not as pronounced, the divergences. And there's another non-tech. Adobe's a tech stock, negative divergence right there. Minimum target for me on this one's 470. And like many others, I think it's going to ultimately come down and visit these trend lines off the lows. So it's got a lot of downside. There's a big old gap right there. They'll probably step in and buy on the way down. But ultimately, I think it works its way down here to that 390 level and intersecting uptrend line, which should come in, I would say, when it does, we get down there, it's probably going to be, that's telling me that would be around the end of October. And I'm just moving. Remember, stocks tend to fall a lot faster than they rise, maybe early October. Let's see when the trend line comes in. Yeah, right there, around, call it late October, maybe November. So I'll try to remember. I probably won't to revisit this, see if we're right on that. So that'd be about a 25% drop in Adobe, and that's what it looks like to me. Cisco, tech, big divergence, negative divergence, building. And a lot of these divergences, because of the scope of them, they also, you can see these divergences out on the weekly. They rival the magnitude of the divergences we had leading up to the bull market highs. And remember, most stocks are still in a bear market, or at least below the previous bull market highs, which you can therefore make the case that we may still be, that this may only be a bear market rally. I know fewer and fewer and very few still maintain that position now. From what I read in the headlines, what I see on TV and videos I watch, but this one could easily be the catalyst for the next leg down. And say what you want, all I can tell you definitively is we have big negative divergence, just like we had big positive divergence here at the lows, right, and a bullish falling wedge, and it gave us that, and we had negative divergence there. So really, I don't, sometimes I think people overthink these things. This is what I see. I also see big divergence up here. If Cisco, I don't know if they reported yet. Probably not. I don't see any big moves. But this was their topping pattern right here, and that was big support. It was finally broken here, back tested. This would be the first back test. So if we have a little more upside next week, you can short it objectively just under that 53.78 level with a stop somewhat above. Or, if you're bullish, you want to buy a breakout. I wouldn't buy the breakout because we have the negative divergence, and I think any breakout's likely to fail. I would just let it go. That's me. All right, let me give you a few more. Netflix, I already addressed that one before and after earnings. Figured it would sell off based on the bearish technical posture. It has. Another down day today, down another 2.5%. AstraZeneca, here's another one. This is what I was trying to get to, and it took a while because you had to go down. Here we are. I'm already on the 15th holding, and I realize I've hit like 2 non-tech stocks so far. AZN, looks better than any tech stock out there, although we did already peak with a negative divergent high. We had the trend line break. There's your sell signal. It went down. I may have already highlighted that one as a short trade on that break. I can't recall. Probably, if I had these lines there. And we're coming up to resistance right here. Again, I'm not crazy. I wouldn't go long. I think there's more downside, more meat on the bone on the tech stocks I showed you. But if this one gets rejected off there, move that right to the gap there, 70.28, and we're probably going to come on down to the primary uptrend line there. AMD, another tech stock, breakdown, back test, support right there at 108, and again probably headed down here. So this just gives you a gauge, of where, I'm pulling these lines. I'm coming up with numbers around 20% to what I'm calling preferred swing targets, not initial targets. This would be my next target here on AMD 99.61, but then that may come in if and when we get there with the trend line. We'll see. But this is what I'm looking. I'm going to put that trend line right about there right now. So yeah, we'll call that. And that changes a little, guys. Sorry to do that to you. Let me move that back to where I had it, because I want to keep on these candles. Yeah, that's where I think it should be, right there, and that is, yes, 20%. That's the best fit I can give that trend line. So that's where I think that one's going. 2 more and we'll wrap it up. This video ended up being longer than the last one. I don't know how that happened. Comcast, not a tech stock. This is in the telecom service sector. Everyone knows what Comcast does, but they also universally own, a lot of, bigger things, but they're not really considered a tech stock, more of a media company. And there it is. You have the big negative divergence, big bearish rising wedge. The last time I see anything that looked like this was right here before the market topped, and that was a comparable wedge right there. Divergence building. Your sell signal was as clear as day right there. Big red candle down through there, and it gave you this before all said and done. That ended with a little divergent low, gave us this, and now we've come full circle. We have a nearly identical bearish rising wedge pattern confirmed with comparable divergences as we had back at the top. And so I know, again, just from reading and listening that, and even the comments on this site, that very few believe, most don't even believe we're going to see anything more than a pullback of 5% or so, a great dip buying opportunity, maybe a pullback to the 200 days. But the charts, I'm still very open to these new lows that take out the October lows, and then you're talking, some pretty big drops. And it's not going to happen overnight. There'll be plenty of zigs and zags down the way, but be careful on that too. I'm gonna end it here. Yeah, let me end it here and just say this, that the nature of bear markets, if this one plays out the way that I've been figuring it would before it even started, going back to before the top in late 2021 in the Nasdaq and early 2022 in the S&P, is that it's going to be a much larger, longer bear market, bigger in magnitude, bigger in duration, and it's going to take a while to play out. And but if that is the case, and let's look at the S&P, doesn't matter. We can look at QQQ or the S&P. It doesn't matter. Let me just turn off the lines. If you're familiar with Elliott wave theory, there's little counts within here. But if you're looking at the larger wave structure, that would be, might consider that down into the October lows. If you're looking at a primary 5-wave cycle, then you have an A down, B up. C is always the largest wave on a 5-wave cycle. I'm sorry, wave 3. And then you have a 4 ended with a 5th wave final. So, and again, and I'm not doing this to scale in time here, but it could take a long time to play out. And, when I look at my long-term trend lines, this is a long-term secular bull market uptrend line that hasn't been visited since the last bear market. The last two, that last bear market, and this comes back off the early 80s lows. I have some notes on board 4. And these are my long-term targets I've maintained since before this thing started. I have long-term trend targets. This is my if things get ugly target down here. And this would be like, well, whatever. We'll get to that later. Let's see. First things first. I'll go over long-term targets if we start to get some traction to the downside. Right now, we're so close to the previous bull market highs that I'm getting ahead of myself talking about the longest term potential targets. Right now, I'm focused really on those kind of the trend lines I gave you off the lows. Let's just say that's the kind of the targets of that I'm eyeing right now for potential swing pullback trades, particularly in the tech sector, semis, things like that. And so we're calling for about 20% drop in the semis, and that might be a little less than that, 10% or so in the Nasdaq 100 as of this point in time. Just ballpark, rough numbers. Okay, long video, but it's the weekend. I'm going to wrap it up here, get it out to you, and we'll pick it up Monday. Just remember, the fireworks should begin on really on Wednesday, because you get the two biggest stocks reporting next week kick off on Tuesday after the close, and then so you're going to know, the market will know what they're all about on Wednesday, and then you got the Fed coming, and you have some other big things reporting next week on Wednesday and Thursday, I think. So it should be an interesting week, guys. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.